The South Korean won is hovering at precarious levels, threatening to lock in a new normal of 1,481 to the dollar. To discuss some more about the government's all-out response and what this means, our Kim Do-yeon joins me in the studio. Do-yeon, let's start with the numbers. They've been extreme. Where do we stand right now?
Right. First, the South Korean won today closed at 1478 to the dollar at the market's closing today. But let's see the yearly trend. We started the first quarter with an average of 13.99 won to the dollar. Things worsened in the second quarter and hitting an average peak of 1453 won. We saw some stabilization in the third quarter, dropping back to the 1301 range. But that relief was short-lived. In this fourth quarter, the average has shot back up, reaching the 1475 won mark. Effectively, the high exchange rate is no longer a spike, it's becoming structural.
So we are seeing a structural rise. And the question is, why is the won so weak? Is it just external factors like the strong dollar?
Well, it is a combination of both. But experts point to a fundamental imbalance in supply and demand within Korea. Experts explain that while everyone wants dollars to invest in the U.S., no one wants to sell them, which is fundamental to what determines the market value. Exporters are also holding onto their dollars, expecting the won to fall further, creating a supply crunch.
Demand for dollars is high because investors are leaving the Korean market for the U.S., while supply is low because exporters are holding on to their dollars. Those who have already invested in the U.S. are also keeping their profits there instead of bringing them back.
So it is a vicious cycle. Now, the government seems to be waging an all-out war to, break this loop. What are they exactly doing?
So the government is tackling this from multiple fronts. Now, it started with a simple message, acknowledging the issue. Now, agencies have been meeting constantly. Even this morning, Deputy Prime Minister Ko In-cheol and chiefs of the Financial Services Commission, Financial Supervisory Services, and the Central Bank met, saying they'll be monitoring the exchange rate 24/7. And the latest measure came from the Finance Ministry with more focus now on help from private institutions. It raised the limit on foreign banks' foreign exchange positions to 200% to physically bring more dollars into the system. On top of this, the presidential office summoned executives from 7 major conglomerates this afternoon, including Samsung, LG, and Hyundai Groups, a direct SOS asking them to release their dollar holdings. As I mentioned, exporters are hesitant on turning their earned dollars into won right now. Now, what was groundbreaking was when financial authorities said it will use the National Pension Service. The National Pension Service runs around 800 trillion won or 670 billion US dollars in foreign investment, which is around 60% of its total investment. And it does hedge against the dollar to keep won stable, but it doesn't work that well right now.
Because the rules for the National Pension Service's overseas investment are operated too transparently, how much will go out is all known. Furthermore, the decision-making criteria, such as the timing of hedging or when to stop hedging, are too well known to overseas and domestic market participants.
So the new plan is to make these rules less transparent and more strategic, effectively hiding their course to keep the market guessing.
So those are some aggressive steps, but I do have to ask, will these work? And with the current level of the exchange rate, is the nation in danger of having a financial crisis?
Now, first, historically, the government has been involved in dealing with the foreign exchange market when it affects the nation's economy. Now, the goal is not to distort the market while making policies favorable to strengthen won. As for the conglomerates exchanging their dollar profits into won, that might not be a sustainable measure.
Even if these large companies release their dollars, individual or institutional investors are likely to buy them up immediately to invest in the U.S. So while there might be a short-term impact, it is not a sustainable solution.
Now, for other measures, we will have to see. And as for your questions on whether this could become a financial crisis, the BOK governor defined this not as a financial crisis, but as a livelihood crisis.
I completely disagree that this is a traditional financial crisis. But in other respects, I would call it a crisis, and I am deeply worried. The current exchange rate has a significant impact on inflation. Furthermore, When rates rise like this, the divide between those who benefit and those who lose becomes extreme.
He warned that if the exchange rate stays at the 1471 level or even goes higher, inflation next year could jump from the forecast 2.1% to mid 2% range, deepening the economic divide between exporters who benefit and households who suffer.
I see. Doyan, thanks for the coverage tonight. I appreciate it.
Thanks for having me.